Hey everyone, welcome to Retire with Style. I've apparently taken this over because I'm running right in from the intro. But we're here with Alex and Wade as my guests this week to talk about tax loss harvesting. So guys, if you want to introduce yourselves.
Hi, I'm Bob French.
I'm Wade, and we got the Don Pardo of Retire with Style is here on hosting duty today.
He has the voice of Johnny Mathis.
But that being said, I'm guessing after last week we better get to the point real quick this week.
We're losing subscribers by the second. My inbox is out of control, Wade.
But, yes. This is how we end up doing those 10-minute intros.
To make sure that everyone's clear, this week we're going to be talking about tax loss harvesting, which in a year like 2022 has a lot of practical application. And so it's very fortunate for us to have Bob join us to be able to walk us through some of the issues just on an ongoing basis. And then also I can bring into that conversation as well, just with retirement and how tax gain harvesting can potentially play a bigger role in retirement at the same time.
Absolutely.
But yeah, there's a lot to cover this week. Do you have any other small talk there, Alex, before we get started?
Don't tempt me, Wade. And by the way, when you said that, probably some percentage of our viewers are rolling their eyes like, oh my God, here we go. Let's do the fast 30, fast 30, fast 30.
Yeah. That's an important
I got nothing. Oh, I got one. So Wade, what are your kids going to be for Halloween? Any thoughts?
Yes, I've got a Pokemon in the household and ketchup. I guess there was some kind of outtake from Stranger Things where they said, hello, I'm ketchup and I'm mustard. And so her two friends are going to dress up as ketchup and mustard.
Really?
I would also point out this is going to be going out like more than a week after Halloween here.
That is true.
Okay, so Bob,
we're no longer evergreen.
So Bob, what's your favorite Halloween candy? And tell us all about candy corn and how much you hate it.
I don't. I like candy corn, believe it or not. But I'd go with Butterfinger.
The day this comes out on election day, you may be tired of candy corn.
Oh, really? Okay, and I got one more, Bob. This is for post Halloween.
I'm not the one egging you on here, Alex. This is Wade's doing.
Why don't vampires eat ghosts?
I don't know.
Wade?
They have boo instead of blood? I don't know.
Because they taste like sheet.
All right. On our podcast for that.
No. It works. It works, Wade. All right.
Cover
How's
the
that, Bob?
Ears.
Is that? I don't think they'll be listening to a podcast on tax loss harvesting.
Everyone. But yeah, let's actually dive in and see if we can keep it under 4 minutes before we jump into it.
This is a full service podcast.
That's right. But yeah, obviously, as Wade said, 2022 has been a less than awesome year in the markets. And with that comes a lot of stuff. But one of the things that pops up a lot, or that at least we hear about a lot, is tax loss harvesting. Is this something you should be doing? What is it? Does it make sense for me? All of the questions. So we want to take a little bit of time and walk through, well, what is tax loss harvesting? How do you do it? Does it make sense? And as Wade alluded to, there's the flip side of the coin, the tax gain harvesting. And how do we approach all that type of stuff? Basically, how do we manipulate our capital gains taxes? And does it make sense to go down that road? So, Alex, do you want to?
Well, just before to start that, just because I'm taking like most common denominator here, listeners, tax loss harvesting. Bob, that's for losers. We should focus on gains. No, I mean, I've heard advisors even say this, like tax loss harvesting. That's un-American, that kind of thing. You're all of a sudden recognizing losses. Don't give up. Don't ever give up. That kind of silliness.
Yeah.
What's your take on this? And where I'm going with this is just dispersion of individual stocks, and so not just mutual fund asset classes, but even normal dispersions. And you'd be silly not to capture them. But I'll let you just start off.
And also for background too, Bob, very basic background. I think it's probably also worth defining the idea of cost basis and what that means and how that's relevant to this.
Yeah, we'll try and keep the discussion of investment taxes relatively high level, but I think we do need to talk about cost basis here, unfortunately. And
okay, so you have 2 points. We'll just sit back and listen. Go on.
Okay. So we'll start off by officially calling out, none of us are CPAs here. None of us are handling your tax situation. So talk to your tax professional. But, the idea with tax loss harvesting, one, it's definitely something that a lot of people can use. We'll talk about the provisos around that can statement in a little bit. But markets bounce up and down. They're moving all over the place. And even in good years, there are going to be certain asset classes and certainly certain stocks that are going to go down. And, depending on the specifics of your situation, you might be able to harvest those losses and reduce your taxes in the current year. Now, we'll talk about, some of the things going on in that statement, but they're absolutely, to the extent that we can reduce taxes, that's a good thing. We want to pay as little to the government as we possibly can, as we realistically can, while still maintaining our asset allocation. We want the highest after-tax return and after-tax wealth specifically that we can possibly get, because we're doing this for a reason. It's not just we want big numbers on our statement. We want to be able to spend this money. And that's really the goal with tax loss harvesting, to manage our taxes through time. So let's touch a little bit on cost basis and investment taxes and kind of set the stage here for what we're talking about with tax loss harvesting. So there's really, a couple things. First off, there's 3 different types of investment accounts, or basically 3 different types of investment accounts. There's your taxable money, your tax deferred money, and your tax exempt money. Your tax deferred and tax exempt, you also hear those tax advantaged, but it's your IRA, it's your 401k, 403b, all of the kind of accounts with letters and numbers associated with them. Tax deferred means that generally you're going to be able to write that money off on your current year's taxes, and then you're going to pay basically income tax when you pull that money out in retirement or whenever the case might be. Tax exempt accounts, you're putting in after-tax money, so you don't get that tax write-off. This is your Roth accounts. But you're done paying taxes. You're just done. That money is yours, free and clear. You don't pay taxes on it while it's invested. You don't pay taxes on it when you pull it out to spend it. Your taxable accounts are the ones we're going to be talking about here. These are the ones where you're paying taxes on everything that happens as it happens. This is your brokerage account, basically. So within this account, there's basically, I'm going to be saying basically a lot this episode, so sorry. But there's basically 2 types of it, or 2 big categories of investment taxes that I think is a fair way of phrasing this. So there is your, income tax, so dividends, other forms of distributions and stuff like that, interest income, where it just goes into your income and you pay whatever your income tax is. There's also capital gains. These are, basically the gains you've made from selling an asset, or an asset being sold in your name in the case of mutual funds or ETFs or things like that. That's the stuff we're going to be really talking about with tax loss harvesting, by and large. There's one exception. Now, what Wade was getting at with his statement about cost basis is how those capital gains taxes are figured out. So let's say I own, $100 worth of Ford, just to pick a random company. And I go and sell that $100 of Ford stock. My capital, what I'm paying taxed on, is not going to be the $100. It's not going to be the amount of money I got from selling that stock. It's going to be the amount of money I got from selling that stock minus how much I paid for it. So if I paid $80 when I bought that Ford stock, my capital gain is going to be that $20. So the $100 I sold it for minus the $80 I bought it for. My gain, my profit is going to be that $20. And then I'm going to be taxed at whatever my capital gains rate is on that $20. Now, one of the really important things here is that if I've held that stock for more than a year, it's considered a long-term capital gain. And that long-term capital gain for most people is going to be a lot lower than their income tax rate. I'm taxed at a lower rate on those capital gains than I am on the things that are in that income bucket. Again, like most dividends, interest income, returns of capital, all sorts of fun stuff when we start going down that rabbit hole. But that's really what Wade's getting at with cost basis. It's how much you paid for something. Now, I think, Wade, correct me if I'm wrong, I think that's as much accounting as we actually need to go into to get into the statement or get into the discussion here. But that idea of cost basis is really, really crucial when we start talking about basically manipulating cost basis here. Alex, you look like you're about to say something there.
No, so just to even drive home the beginning point, like if you're think about the S&P 500, just to go back to the statement that there are always going to be losses, especially if you have a lot of individual securities. If you think about the S&P 500 stocks, the S&P 500 is up 10% that year. Not every stock is up 10%.
Yep.
There's a dispersion around that number, and a handful, in fact, disproportionately, I would say a lot more of them are down than up, because it's usually the winners that kind of carry the day, if you will. So there's always opportunities, especially with individual securities. You have a diversified portfolio with, let's say, 10 or 12 asset classes, invariably you're going to have an opportunity along the way. And we're doing this right now because this year, we wanted to give people some time because it's, there are more months to begin to, you still have a few months left to develop a tax plan around it. But, unless you're extremely lucky, you're going to have significant opportunities to harvest losses this year. And it has nothing to do with investment acumen. It's just, as an investor, your role is to capture stock market returns. Yep. And some years, it's a negative return.
Right. Absolutely. And that works both ways. Even during really bad years, there's going to be some stocks that do really well. Back in 2008, when the market as a whole was down, 44%? There were companies that was an awesome year for them. During the height of the pandemic, Zoom and Peloton and, all of those companies, everyone else's, their stock crashed. They did really well. There's always going to be examples. And, during good years, there's going to be stocks that do really poorly, as Alex said. So getting back to the idea of tax loss harvesting, what we're really doing is, we're harvesting those losses. We're harvesting those situations where a stock has dropped below what your cost basis is. Now, I put that in there specifically in that way because it's not just if a stock has gone down over the past week or month or something. It has to have gone down relative to where you bought it. So you're losing money on it. You lose money on it, exactly. So if you bought AT&T back in 1960, a one bad quarter, you're probably not going to have a tax loss on that. There's probably nothing to be doing there. But a stock that's gone down a little bit more significantly, there might potentially be something. And, if you really want to go down the rabbit hole, you can start looking at tax lots and, manipulating that and figuring out exactly which shares you want to sell, to really really dive into it, but I think that's probably going to be overkill for a lot of people. But,
Well,
what I really wanted to
how
get
else
into...
do you do it? I thought you
What's
have
that?
to go by tax lots to be able to...
Well, most people have it set up for them, I think is a better way of phrasing it, as average cost basis trading. So you can see, if you have your account statement and it says, the Vanguard S&P 500 fund, your cost basis is X, that's going to be the average cost basis. So, for most people in most accounts that, if you go and make a trade, they'll be trading at least at the mutual fund level. They'll be trading at your average cost basis.
Yeah, we can get into LIFO and FIFO some other time.
Yeah.
And maintaining it once it starts.
But, we as in Retirement Researcher will be having something coming out shortly, much more in depth on tax loss harvesting, and really tax efficient investing in general. But there's obviously a good chunk on tax loss harvesting in there. And we do get into all those different strategies and things like that. But I think we can kind of keep it a little higher level than that here.
So then, Bob, okay, you're reassessing your portfolio. You've given up faith that Peloton, you bought Peloton in January. You've given up faith that it's going to come back all of a sudden because of their new rowing machine, right? So you're down, whatever. You bought it for $100. It's $20. You're down $80. Yep. What can you do to turn that into lemonade?
Yeah. So, and that is a really important point. This is very much kind of a silver lining type of strategy. You would have preferred not to take the loss overall, but since we have it, might as well do something with it. So the mechanics are pretty straightforward. We'll get into something called the wash sale in a little bit, which is always the difficult piece here. But, you sell, Peloton, and you take the money and, you can do what you want with it at that point, again, per the wash sale. And then with that $80 loss, you now get to reduce all of your other capital gains for the year. And that's a really important point because your capital gains on your taxes every year are netted. It's all added together and it's just saying, here's how much you made or lost in terms of, capital sales, basically. Now, one of the really, really interesting things here is that if you have more losses than gains, if you have a capital loss overall for the year, you actually are able, again, this is very kind of situation specific, but in a lot of cases, you're actually able to write off a certain amount on your income taxes. For most people who are married filing jointly, it's $3,000 per year, or in a year, I should say. And remember what we said earlier about income taxes being higher than capital gain taxes. That's worth a lot. That's a good chunk of change that you're able to do that just by harvesting those losses.
Now, you may want to be clear, offset versus deduct. What's the difference?
So it's a straight reduction. So, if I'm just working and I say, let's say I have $1,000 of other capital gains from just whatever else I'm doing in my portfolio in the year, or whatever distributions are sent my way or whatever it might be. And I am able to harvest $100 of losses. Well, now my capital gain overall is $900. I'm going to be taxed on that $900 gain rather than $1,000 gain. The same thing on your income taxes. If I'm able to deduct $3,000, if I have, $5,000 of losses and I'm able to take $3,000 of that and apply it to my income tax, well, my income for the year is $3,000 less. And then, with that other $2,000, I get what's called a capital loss carry forward. And that's just a really fancy way of saying we're going to apply that $2,000, or you have the option of applying that $2,000 loss at some point in the future.
Now, is there a limit on cap gains that you can offset?
No, it's purely netted. Because again, think about it at the taxpayer level. It's saying, okay, what were your gains on, sales of assets this year? Well, it doesn't matter how much stuff you're doing. It's just your profit and loss statement, basically.
And you are netting the long term. Did we mention
Yes.
the difference between long term and short term?
We probably not as much as we should. There are two types of capital gains. There are short-term capital gains and long-term capital gains. Long-term capital gains are gains on things you've held for a year or more. Or actually, Wade, you might know this better than I. Is it a year or more than a year? So,
right, that's a good question. I would always just
don't sell it on the
err to the side of wait until 365 days plus one, just to be safe. But I don't know.
Because that is definitely something that they would get very particular about, I'm sure. But the big reason there is this differentiation is short-term capital gains are taxed like income. Long-term capital gains have a lower tax rate applied to them. So, you want to be focusing on making sure that your trades are going to be in the long-term capital gain bucket rather than the short-term capital gain bucket. To the point that I've actually seen financial advisors decide they're going to rebalance every 13 months rather than every year, just to be sure they never have to worry about it.
So Bob, I've bought the Vanguard S&P 500 index fund. I'm 13 months into it. I'm down, whatever, let's just say 20%. I still don't want to be out of the market, though.
Yep.
What am I to do?
So this is where the wash sale rule comes into play, actually. So basically what the wash sale rule is with all of this stuff, the IRS wants to make sure that when you do tax loss harvesting, you're actually taking a loss. You're not just taking money from one pocket and moving it to the other and basically resetting your cost basis at a higher level. So you'll pay less taxes in the future, or excuse me, pay more taxes in the future. So the rule states that if you're going to take a loss on a sale, you can't buy that security 30 days on either side of the sale. So you can't buy it 30 days before or 30 days after you sell the security to generate that loss. So there's two things that are really important to unpack there. The first is, who is you? You is actually a little bit of a slippery term there because it's not just you. It's anyone in your household or any accounts that you have control over. So the household piece is relatively easy to understand. If your spouse is, buying that same security you're selling, that can trigger the wash sale rule. Or like if you have a business account or something like that. Again, the IRS wants to make sure the state tax boards, whatever it's called in your particular state, they want to be sure that you're actually taking that loss and not just moving it from one account to another. So that's definitely something you want to be paying attention to. And that's actually one way that a lot of people trip up here, because this is actually where people get caught up with basically automated purchases. So like say you are automatically saving into your 401k or something like that. If you go out and, you harvest a loss, let's continue with, the S&P 500. I have an S&P 500 index fund in my, my 401k. I have money taken out every paycheck and, that's part of my allocation. So it just gets sent there, every 2 weeks. If I then turn around in my taxable account and sell even a different S&P 500 index fund, we'll talk about that part in the minute or two here, I'm likely to trigger the wash sale rule because I'll sell that, generate my loss of whatever it happens to be. But then, one, I've probably already bought it within the past 30 days, but I'll also probably buy it again in the next 30 days. So I would actually not be able to take that. So you really need to have a tight control, or at least a tight idea of what's happening in your portfolio at a pretty holistic level. So that's, if we're going to be going down this road, you need to have really good clarity on what's happening.
And I want to make the point, Bob, your example isn't, you're not detailing an example of 2 taxable accounts.
Nope. It could be even your spouse's.
No, but what I mean is you're saying, yeah, exactly. A 401k account could be, automatically buying the S&P, whatever, the SPX.
And
every
since you're not actively making that purchase decision, you might not even think about it.
Exactly. That is a really, really common way for people to.
And it's a different account altogether.
Yep. You might not even, there's a lot of couples that, even if they keep their finances separated, you literally might not even know that your spouse is buying, has the S&P 500 in their account. The IRS doesn't care. It's, money under your household. So you're responsible for it. So the other piece there is the substantially identical part, which I didn't call out specifically when I gave you the rule. So the rule is not just you can't buy that specific security, but you can't buy anything substantially identical to that security within that 30-day period on either side of the sale. And substantially identical it's definitely a term of art, but it's actually an understandable term of art. So getting back to that S&P 500 example that we're using here. So if I want to harvest a loss in an S&P 500 index fund, I can't go out and, obviously I can't go out and buy that same S&P 500 index fund. I can't go out, if I'm harvesting from the Vanguard S&P 500 index fund, I can't, turn around and buy that Vanguard S&P 500 index fund in another account. But I also can't go out and buy another fund that tracks the S&P 500 index fund. That would be substantially identical because there are going to be very slight differences in the fund. They're not going to be exactly the same thing, but they're actively trying to be exactly the same thing. Basically, they're trying to be, they're trying to deliver that same risk profile. On the other hand, if I were to go out and buy another large cap index fund, so say Russell 1000 index, that would be fine. Those are different funds. Those are things that are not substantially identical. If for no other reason, the Russell 1000 has 500 more names in it than the S&P 500. It's, if we take a look at it in terms of market cap, it's going to be a little bit smaller than the S&P 500. It's going to have a slightly different risk profile. It's probably going to fit in that same bucket for your asset allocation, which is really important, as we'll talk about in a little bit. But it's going to keep you on the right side of the wash sale rule.
Hey, Bob, and something we do practically, and I'll bring McLean into this.
Yeah.
We have asset class selections. These are the funds or the ETFs or what have you that we want within the asset class. We have the main ones that we go for, but we have a bullpen of substitute funds because, at around the fourth quarter of the year, we start taking a look at it and we look for opportunities in which, if there was an opportunity for tax loss harvesting, we're somewhat agnostic with regards to capturing these factor exposures in, let's say, the Russell 1000 versus the S&P 500. And so you'd be well served to do that within your own portfolio of having like substitute funds at the ready. You want to maybe just
absolutely. And it's funny you should mention the McLean angle here, because last month we had Jason Dye, who is the head of McLean's investment operations department, on within the Academy for our quarterly investment review to talk about some of this type of stuff and how McLean kind of handles it. But absolutely, McLean has kind of a backup list, and actually for nearly all asset classes, kind of a tertiary list of funds. Basically the top 3 funds that they like for that asset class. And if there's a tax loss harvesting in large value, just to pick a random one, we can sell the fund that is representing that large value asset class where there's a loss, and then just turn around and buy whatever is the second best fund in the asset class.
And there's
now, go ahead. I'm sorry.
I was going to say there's a couple of caveats to that. You have to feel comfortable enough with that fund, because if you buy it and during the span of a month where you're quote unquote waiting, if it doesn't move, fine. It's just a transaction cost, if at all, if you want to get back into it. But if it goes up by 10, 15, 20%, you're going to stay with it. I just wanted to throw that out there.
Yeah, no, and that's actually a really big thing that you need to be thinking about with this. And if we step back for a second, when you do tax loss harvesting, when you get that money in, when you sell the thing with the loss, you have a choice to make. Well, ideally, you've made the choice before you do the transaction, but there's a choice to be made there. You can just hold cash and wait out the wash sale rule, and then just, on day 31, go back in and buy the original fund. That means we're sitting out of the market for, however much we sold over that period, which, once in a while, that's probably a good thing because the market went down during that period, but that's not the way to kind of bet.
That's random.
That's random. Exactly. The alternative, obviously, is to, put that money to work, to invest that money in that, as we've been talking about, that backup fund, or as the case may be, that tertiary fund, if we've been doing a lot of this stuff. What happens at that point is kind of a binary, I guess 3 possible outcomes. The market can have gone, or at least that security can go down, which, as Alex said, obviously we don't want it to go down. But in terms of this, our decision is pretty simple. Will we move to the original fund, which presumably we prefer to the backup fund? Otherwise, it wouldn't have been the backup fund. It can just stay about the same. Neither materially went up or materially went down. Again, same thing. It's very easy to move back into that primary fund, or the security could have gone up. And at this point, we now have capital gains to deal with. We now have another tax question. And as we discussed earlier, now we're dealing with a short-term capital gain taxed at your income tax rate. So now it's really weird to talk about the market going up being a problem, especially in the context of we're dealing with losses here. But we do have a problem. We're now in a fund that we've already said is suboptimal, not by much, but it's not as good as our original fund.
They don't have to be, Bob. Sometimes it's just, honestly.
There's presumably at least some sliver of difference between the two. You would have picked one, there had to be a reason you picked one or the other. It's very rarely a coin flip. But that gets to the point here that I'm going at, that you have to decide how aggressive you want to be in getting back to your original fund. If it's a situation like Alex is getting at where there's no meaningful difference, this thing is 1 basis point, slightly more expensive, or I don't know, you like the color on the account statements a little bit better.
That's a meaningful difference. Thank you for bringing that up.
I know that's how you make decisions about your portfolio, Alex. Then you're not going to be willing to pay all that much to move back into the original fund. If it's a big deal, if there's a lot going on there, there is a real reason why you picked the original fund over the backup fund. Well, you might be willing to pay a little bit more. You might be a little bit more aggressive in moving back to your original fund. And there's a couple ways that this might happen. There's definitely situations where, it's relatively easy to kind of get trapped in your backup fund. If you get a really big market move during that month, which happens, you may have to wait for a year. Wait until that's a long-term capital gain again. to be able to get back to that original fund. You may just bite the bullet and say, well, it's a big enough difference. There's a big enough expected return difference between these two funds that I'm willing to pay, whatever this short-term capital gain is. It's really going to come down to the specifics of the difference between the funds and also what the tax is going to be, how much you would actually owe on the trade.
Now, Bob, something that a recurring theme in our podcast about like the dynamic distribution strategies and all of this stuff was sometimes a level of specificity is just not worth the calories.
Yes.
And so there could be a subset of our audience that's thinking, you know what, this is crazy talk. I'm not going to do all of this. I'm going to stick to my preferred investment because that will net out, better.
Yep.
And your thoughts? I have thoughts obviously on that. I'm sure Wade does, but what do you think?
I don't do tax loss harvesting in my own portfolio. I don't think it's worth, for myself, I don't think it's worth the tax benefit. I don't want to spend that much time looking at it. There's a lot of kind of fiddling with stuff that you got to start doing when you do tax loss harvesting. It makes sense for a lot of people, but not everyone.
And you know how you feel when your phone charger is at 100%? I get the same feeling. Although you said you do this without considering the tax lots, I feel much better about life when I have one tax lot instead of tons of tax lots. So I took an opportunity in 2020 and again this year to consolidate more or less. But that's because otherwise, you make the point, maybe there isn't, although we don't want to say there's actionable content today.
Yes.
But also for retirees, you do have the step up in basis that wipes out if you're harvesting gains against losses. Well, any large gains that you may have get reset with that step up in basis at death. Plus, if you make charitable contributions, low basis stock can just go directly to your donor advised fund or to a charity. And then you don't have to worry about paying the capital gains taxes on that either. You don't necessarily have to offset all that with gains or losses from other shares.
And I'm glad you called out the charitable contribution piece. We are getting towards the end of the year, so that's something that people are going to start looking at. Definitely look at contributing low basis stock or just holdings to charity. That's a really good way to manage your taxes.
I think there's a lot of financial planning thing, and look, it just depends on your temperament. Obviously, Bob has his. I'm kind of along with Wade. I actually take advantage of tax loss harvesting. When it presents itself. I have no issues with that, and I think there are a lot of financial planning benefits that come along with it, such as we're thinking about gains from stocks, but you can offset gains from a sale of a property, a sale of a business. If you know that in 5 years you have an upcoming gain, you can start harvesting losses specifically for the offset purposes, which I think can be huge, especially when you're talking nominal amounts. I mean, we're not going to talk about it today, but you can do direct indexing strategies where you're effectively mimicking the returns of the S&P 500 with, let's say, 150 stocks, in which there will be losses along the way. But that gets complicated over time. I don't want to get into that right now. You're just talking about straight up losses. But I do agree to the degree. I simplify it from the tax loss standpoint, per Wade's comment. But when it's there, I take them, and they're actually quite valuable for myself.
Yep.
So
it's very much going to be a question of how much, if you're looking at an event driven strategy, that's one thing. If you're looking at it saying, shoot, the market's been down, let's go take a look. That's one thing. There's also, you can be looking at this as a regular part of just your portfolio management strategy. When you go in to rebalance your portfolio, you can also go in every year and look to see, is there something I can harvest? Is there some losses that I can be looking at? But, one of the things you want to be thinking about is, as Alex said, is the juice worth the squeeze? If you do this tax loss harvesting trade, are you actually going to come out ahead when you think about everything? Depending on your account, you've got potential trading costs. You've got potential. You got potential gain or gains. You got potential, not just potential. You got your time to consider. But what you want to be doing is, really what this is coming down to is you don't want to be looking to try and harvest when there's a $5 loss. You want to be looking to harvest when there's a material loss, and it's up to you to determine what material means in that context.
Now, that's the loss. Is there a flip side to this? Wade, I know you had an idea on the other one. Maybe it's a good time to transition.
Since this is retire with style, we can't forget about, and I don't know if this is the correct technical name, but I just tend to call it capital gains harvesting.
I prefer tax gain harvesting here, Wade.
Yes,
so.
Tax gains harvesting. And this just speaks to something retirees may look at. And also, just to be clear about this point, there's no wash sale rule if you're harvesting gains. You can realize the gain and then immediately repurchase the same.
Yeah, the IRS
as long as you're not trying to offset losses.
Your money.
Why would you do that?
Right. The reason why you might do that, just suppose you're retired, and you do have to look at all these other implications. So suppose you're in your 60s, you're not yet claiming Social Security. You also, maybe you're not getting, if you're on Medicare, you're not using the Affordable Care Act, so you're not worried about subsidies for your health insurance necessarily. If you don't have any income, you have a lot of capacity where in 2023, for those married filing jointly, they have a 0% tax bracket on qualified dividends and long-term capital gains up to $89,250. And if you add the standard deduction on top of that for married filing jointly, you're getting close to almost $120,000, where you could just realize $120,000 worth of long-term capital gains and still be at the 0% tax bracket. So you're paying taxes, but at a 0% rate. And that's giving you an opportunity to effectively reset the cost basis of your account at a higher level. So alongside Roth conversions.
Resetting, what does that mean? Resetting the account at a higher level?
It's like by selling and then immediately repurchasing, my cost basis is now that $120,000 than it was before. So that later in retirement, if I need to sell some shares to fund expenses, I would have be realizing less capital gains at that time because I now have that higher cost basis.
And later in retirement, your tax bracket, now that you're getting Social Security and all of that, will be higher.
Mm-hmm. Right. And that's where you're now getting Social Security. You now may be hit by required minimum distributions. This long-term capital gains stacks on top of other ordinary income. And you could be getting into situations where the Social Security benefits or the required minimum distributions are now pushing some of your long-term gains from the 0% rate to the 15% rate. And by just realizing those gains back when you were able to do so in a 0% rate, you're saving yourself on the taxes over the long term.
Yeah. And I would also say that, if you're in that situation, you'll also want to be looking at Roth conversions, another topic that comes up a lot in those points. And actually, I believe McLean, has some resources. We'll put them in the show notes again, but some resources on figuring out whether a Roth conversion works for you in your situation or not. But yeah, tax gain harvesting is absolutely something that, especially in those periods where you have a lower income or a relatively low income, where you're in a lower tax bracket than you quote unquote normally would be, where you definitely want to take a look at it and see if you can't take advantage of it. It's really powerful.
Mm-hmm. And it doesn't get as much attention because there may be fewer opportunities. There's a very wide range where you're paying 15% on long-term capital gains. And if your incomes are at those levels where that's an issue, there may not be much you can do. Also, once Social Security begins, you might trigger long-term capital gains thinking that you're in the 0% bracket, but that could cause you to be hit by that Social Security tax torpedo, where you're paying taxes on a bigger percentage of your Social Security benefits. And therefore, you weren't truly in the 0% marginal tax bracket on those long-term capital gains. So there may be fewer opportunities to benefit from this. But when it's there, it's always great to pay taxes at a 0% marginal tax rate. So
that's a great point.
Good to take advantage of that.
Bob, would you do that, or will you pass on that as well?
I would. Unfortunately, well, no, fortunately, I am
good to
not
be
in
Bob,
that
Wade.
situation.
Good to be Bob.
Fortunately, I am not in that situation. I am still in my earning years. So unless you're trying to say something here, Alex, I don't think I'll have any opportunities for tax gain harvesting anytime soon. So,
Bob, if you see a $20 bill on the floor, do you pick it up?
I do, but they don't exist.
You
So
must not be an economist.
that's right.
No, because it wouldn't be there if it was real. Right?
All righty. What do you think?
Yeah, I think we covered the topic pretty well. And
Yeah. So, go on.
well, I mean, I think there's actionable content here, especially in 2022. A lot of people may be able to benefit from doing some analysis along these lines and finding potential opportunities to reset the cost basis at a higher level, which can help over the long term.
Listen,
The only thing is,
I don't
before
listen to
we
Bob.
end, I think we're legally required to say the line. You don't let the tax tail wag the investment dog. I think that's required to be in everything talking about tax loss harvesting. And it's an important point that, it's easy to kind of screw up your portfolio if you get too aggressive with the tax loss harvesting and move away from your asset allocation. So it's really important to keep in mind that all of the tax optimization we're doing here is not a small thing, but it's not as big as making sure you stick with your asset allocation, making sure you stick your portfolio where it's supposed to be and taking the right levels of risk.
I agree with that.
And just make sure too, that wash sale rule is really complicated. So if you've never really looked much into this before, study up on the wash sale rule and make sure you really understand it before you start making transactions. Because if you have to unwind things, that gets complicated as well.
And you pay the transactions, you pay all the costs, and you end up with the worst cost basis possible anyway. So
Right. And if you were trying to offset gains against losses, you still get to pay taxes on all those gains, but there's no losses to offset against those gains. And so it may lead to a pretty unfortunate tax situation.
All right.
Okay.
I think we're done. I don't have any more interjections here. So
No, we're good, man.
Yeah,
It was
very
good.
good. Thanks, everyone. And we'll catch you next week on
All right.
Retire with Style.
Great intro, Bob.
and this is why I just do pre-recorded ones.
Yes. Bye, everyone.
Okay, thanks, everyone.